Hi guys, good afternoon and welcome to Mutual Fund Corner. I'm Pavitra Parekh. With me is Sonal Bhutra, and the RBI, like we all know, has sprung a surprise today and paused on rates. This, however, has been followed by rather hawkish comments, right, that came through. So it was quite mixed on that front. The governor has made it absolutely clear that this policy can be characterized as a pause, but not a pivot, and also adding that the decision to pause is only for this meeting. He also said that the MPC will not hesitate to take further action in the future if the need be. So, Sonal, for now, we have a pause after an effective hike of 290 basis points, since May of last year. So how should you look at debt investing at a time like this? There have also been those big amendments to the tax rules. A good time to be discussing debts.
Oh, it should be, right? And as you said, we've seen so much happening just in this category. You spoke about the flows going higher in this particular segment as well. So let's get our guest today. Let's welcome Sandeep Bagla, the Chief Executive Officer at Trust Mutual Funds, to discuss all about debt funds. Thank you so much, Mr. Bagla, for joining us. And that really is the first question. How do you look at debt funds after the RBI rate decision today?
First of all, thank you, Sonal. Thank you, Pavitra, for having me on the show. Of course, I did not know that RBI is going to take a pause before the show was announced. And my view was very similar to my view now, which was that basically when interest rates go down, and they go down when inflation comes down, and the bond markets, the bond prices appreciate, they add capital gains to your portfolio yield. So I think that is going to happen any which way because RBI has hiked up rates so many times, and even globally in the US, rates have gone up. So inflation will come down, and if it comes down, then there's bound to be better returns from debt market strategy. So the policy came as a pleasant surprise because there was no really indication that RBI is likely to pause and introspect as to the effects of what has happened in the market and is likely to impact the macroeconomic scenario going forward. So while of course the language is non-committal in terms of future, I think that it's a great time to invest in debt. One of the parameters which I use is expected inflation and the nominal rate. So nominal rate minus the expected inflation gives you what I think is the real rate. And if the real rate is about 2.5% and you expect inflation to go down, I think it's a very, very good combination for investing in fixed income, long maturity bonds. So currently we have inflation, RBI is expecting 5.2. The market is expecting somewhere around 4.5 to 4.75. And you have the nominal rate at about 720, annualized at 735. So you have a huge gap, and we are expecting inflation to come down. So we could see a rally over the year. And so definitely it's a good time to invest. And what RBI has said today is a cherry on the cake.
Okay, yes, definitely came as a surprise to all of us. I don't think most people expected a pause today from the RBI. But Mr. Bagla, a key risk associated with debt investing anyway is the entire interest rate risk, right? Could you just explain this for our viewers? And how big a risk do you think it is now in the context of what we've seen from the RBI? Do you think this kind of pause that they put through is something that's likely to continue and it's going to be an extended pause? And in that context, take us through how you look at this entire interest rate risk now.
So first, let's take a look at what is interest rate risk. It's not very intuitive because people are used to investing in fixed deposits where the interest rates are, the coupon rate is fixed for the tenure of the bond, for the tenure of the deposit. Now, unlike a deposit, a bond is tradable. So for example, there are some, let's say we have a 10-year bond and the interest rates I bought it at was 8%. Now, one basic rule is that if interest rates go down, bond prices go up. And when interest rates go up, bond prices come down. So let's assume interest rates fall by 100 basis points over a period of next 1 year. And the interest rate at which I bought was 8%. And after 1 year, the interest rates are at 7%. So I am getting 8% as my coupon rate, and 1% fall in interest rates leads to a change in bond price. The second rule that we have to remember is the longer the maturity of the bond, the higher is the percentage rise in bonds prices given a certain percentage fall in yields. So if the yields fall by 1% and the bond is 10 years long, then you will have 7% capital gains approximately. So you were getting 8% coupon plus 7% capital gains. So return could be anywhere between 13, 14, 15%. So that is the impact of interest rate risk. However, one should be careful because it works the other way around also. If you are getting 8% coupon and interest rates rise to 9%, you will get a 7% fall in prices, which will reduce your 9%, 8% carry to by 7%, and you will get only 1% return. So interest rate risk is very simply put, if interest rates go down, bond prices go up. The longer the maturity, the higher the percentage rise in the price of the bonds for a given change in yields. And typically yields tend to fall when inflationary outlook is good. So if expected inflation is likely to come down, you believe that bond prices should do better.
These three things are absolutely so important right before anyone invests in debt funds, especially that inverse relationship between yields and the price of a bond as well. Mr. Bagla, you know what happened in the last week of March was debt funds seeing massive inflows. This is in order to take the advantage of indexation benefit before the new rules kick in from April 1st. How do you see flows looking now? Do you think there'll be a big drop from this level, especially in the debt funds that I'm talking about?
So there have been a couple of changes which have slightly longer term ramifications. And one of them was basically removing the tax indexation benefit given to debt funds. The second was the tax benefit given to what were called the market linked debentures was also removed. Now, for an investor to combine liquidity, safety, and returns, you don't have too many options. If one were to invest in fixed deposits, you know, it's like a passive, no action, no dynamic movement of interest rates is going to affect it, and you're wedded to that coupon for the life of the fixed deposit. However, mutual funds offer you the potential of active management, where the fund manager can increase duration when it feels that interest rates are going to come down, and that can lead to higher returns. Unfortunately, over the last maybe 5-7 years, interest rates have been extremely volatile. The interest rate cycles have become shorter and shorter, which has led to, you know, fund managers and distributors pushing passive products to investors, where they get the comfort of a particular kind of a fixed return they would get at the end of the tenure. But unfortunately, when this works very well when interest rates are going up, because it protects the downside and gives you a committed return kind of. But when interest rates are coming down, the active funds or the long maturity funds will outperform inflation, probably fixed deposits, and the passively managed funds by a mile, by a huge margin. So there was a period, if you remember, in 2000 to 2004, when interest rates were coming down by 1.5% every year, and the returns, I think, from income funds were about 14 to 16% per year for 4 years in continuum. However, that is not expected. Interest rate cycles have become shallow, and if inflation goes down, then typically interest rates are cut. And since most of the regulators are so active, interest rates tend to trade in a range, and which is why people have not really understood the benefits of long-term investing in debt.
Okay, that is good to put on the table, and hopefully, through shows like this, people will realize that as well. But, Mr. Bagla, this new money that we were just talking about, which is sort of rushed into this category in the last week of March, it was, of course, just to get in before that April 1st deadline. Do you think this will stay locked in for the next 3 years? Because this was basically anyone who's sitting on the sidelines who had plans to get into debt. They just sort of advanced their plans, right?
See, I think it would be safe to assume that majority of it would stay invested. Now, this was basically a free option given to investors that even though I don't have visibility on my cash flows, I can still invest in a debt fund. And if I require the money, I always have the option to withdraw it. But I would say 60-70% of it should be remain invested in for a period of 3 to 4 years, unless the tax rules change again. So I think, but in overall scheme of things, not much money has changed hands. So in a debt portfolio of, let's say, fixed income portfolio of mutual funds of 14 lakh crores, about 40,000 crores has sort of moved. I would make this an estimate that about 40,000 crores would have moved into these various kind of debt schemes. So that is not really all that much in a larger scheme of things.
Okay. So, while we are talking about all the indexation benefit taken away, it now being treated at par at the marginal rate as far as tax is concerned for debt funds, of course, there still would be a case for holding debt funds, right, in one's portfolio in order to diversify and take advantage of all the yields that these funds provide as well. What, according to you, is the case here, and what kind of ideal mix do you expect?
So, see, I'll give you a sort of a statistic. We were looking at the CRISIL bond fund index, composite bond fund index. And over the last 10 years, that index has given a return of about 8.75% when I looked at it about a month back. Maybe it's close to 8.75 now. And however, the returns are not in a straight line. So at 1 year, it was minus 1%. In another year, it was plus 18%. So the overall was 8.75%, which is similar to, what was happening in equities also. So equities also, investors have learned that, returns are not straight line. So they have understood the volatility and they have understood the return profile. Now, if you recall, there used to be a scheme in the 60s and 70s and maybe 80s as well, where the NAV was not, where the price of repurchase and purchase was announced without the NAV, which had no link to NAV. And there were tax benefits and there were capital gains, and investors were lulled into a cocoon of safety and tax benefits. However, when the gap became too large to handle, the government discontinued that scheme. The scheme was wound up, and investors started taking the market risk. They started investing in open equity funds, and they have remained invested for the last 30 years. And they have they have prospered from the benefits of live markets, dynamic markets, and open-ended equity funds, which manage funds dynamically. I think this could be that moment for debt funds also. Till now, you had the comfort of tax benefits and perhaps an implicit interest rate which was keeping you calm, however suboptimal it was. But now you have to understand, okay, what is debt? What are the main factors which drive it? Should I invest in an active fund or passive fund? Both are good. But so probably in terms of fund allocation, I think people should have something in FD, some allocation in open-ended funds, some allocations perhaps could be have in passive funds also. But
yeah, that makes a lot of sense to, divide your money and do sort of diversify within, what you can do with debt investing as well. Mr. Bagla, I request you to stay on. We're going to take a quick break and come back. And then I want to actually ask you about some of the individual categories within debt funds that you could look at and your call on them as well. So stay tuned. We'll be right back.
Let's